Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets behind corporate filings. Today, we're diving into a filing from Oxbridge Re Holdings Limited, and let's just say sometimes the simplest agreements can have the biggest immediate impact. We're looking at a Form 8K, which is basically a report for significant events that happen between the bigger quarterly or annual reports. Think of it as a company's way of saying, hold on, something important just happened, and you need to know about it now. What is interesting here is that this event is all about money, specifically a new loan that the company just took on. Oxbridge Re Holdings Limited, the company we're focusing on, is a bit of an interesting one. They're involved in the reinsurance business, which means they essentially insure insurance companies. It is a complex world, but at its core, they take on some risk for other insurers, and in return, they get paid a premium, hoping that the insured events don't happen too often. Now, let's get to the meat of this particular filing. It outlines a key financial event for Oxbridge Re. On the 11th of February 2026, the company, which we'll call Oxbridge Re for simplicity, entered into what is called a promissory note. Don't let the fancy name scare you. A promissory note is essentially an IOU, a promise to pay back a loan. In this case, Oxbridge Re borrowed a cool $1 million. This is a pretty substantial amount for any company, and it signals an immediate need for cash. This $1 million loan comes from Real World Digital Assets LLC, and it is set to mature in 6 months. That means the entire loan, both the principal amount of $1 million and any interest, is due back on the 14th of August of 2026, unless, of course, they decide to pay it back sooner, which they can do without any extra charges or penalties. Now let's talk about the cost of this loan. The interest rate is set at a fairly high 16% per year. To put that in perspective, that is significantly higher than what you might see on a typical personal loan or a mortgage. This suggests that the lender, Real World Digital Assets LLC, perceives a certain level of risk in lending to Oxbridge Re. If things go really wrong and an event of default occurs, the interest rate can jump up to a whopping 36% per year, or whatever the law allows as the maximum. That is a stark reminder of the terms and conditions tied to borrowing money, especially when the going gets tough. The money from this loan was actually funded a day later on the 12th of February, and the company intends to use it for working capital and general corporate purposes. In simpler terms, this is cash to keep the lights on, pay bills, and generally manage the day-to-day operations of the business. Here is a really critical point, and it is something you always want to pay close attention to in these filings. This loan isn't just an unsecured promise. Oxbridge Re has put up substantially all assets of the company as collateral. This means if Oxbridge Re cannot repay the loan, Real World Digital Assets LLC has the right to seize almost everything the company owns to get their money back. This is a huge commitment and a significant risk for Oxbridge Re. It shows just how important this funding was, and the lengths they've gone to secure it. The filing also lists the exhibits, which are basically the supporting documents for this report. We see the promissory note itself and the security agreement. These are the actual legal documents that lay out all the nitty-gritty details of the loan and the collateral. For anyone who wants to dive even deeper, these are the places to look. Now, let's step back and look at this from a bigger picture, a Warren Buffett style perspective. Why would a company, especially one in the reinsurance business, which can be quite cash intensive, take out a loan at such high interest rates and with such severe collateral requirements? The immediate thought is that Oxbridge Re might be facing some liquidity challenges or sees a pressing need for capital that they can't generate through their regular operations or other, more favorable financing options right now. High interest debt like this can be a double-edged sword. While it provides immediate cash, the high cost of borrowing eats into future profits. A 16% interest rate on a $1 million loan means they are paying $160,000 a year in interest alone. If that spikes to 36%, that's $360,000. That is money that can't be reinvested in the business, potentially used for growth, or returned to shareholders. The fact that they've pledged substantially all assets is a major red flag. It tells us that if things don't improve, or if they face further unexpected events, the company's survival could be directly threatened. This isn't just about a bad quarter, it is about potentially jeopardizing the entire enterprise. It makes you wonder what the immediate catalysts were for this. Were there unexpected claims that hit their reserves harder than anticipated? Is there a strategically important acquisition or investment they need to make quickly? Or is it a sign of underlying financial stress? In my opinion, this loan is a clear indication of the company navigating some choppy waters. The high cost and significant collateral signal, a degree of desperation, or a very aggressive bet on future profitability to justify the expense. The key risk here is the company's ability to generate enough income or cash flow to service this debt and repay the principal within that short 6-month window, all while managing its core reinsurance business. If the reinsurance market turns sour or if there are significant claims that hit them unexpectedly, this loan could become a critical burden. Conversely, if this capital fuels a significant new opportunity or helps them weather a temporary storm, it could be a necessary evil. The success of this move hinges entirely on their execution and the stability of their business operations in the coming months. Alright? That is our breakdown of Oxbridge Reholdings Limited's latest filing. What is your take on this high-interest collateralized loan? Does it signal trouble or a strategic move? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and be sure to subscribe for more deep dives into corporate finance. And don't forget to join our Discord community linked in the description where we discuss all things corporate finance. Thanks for watching, see you next time.